Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at SoFi Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we jump into today's deep dive, here is a really useful chart tool for investors and traders. If you're looking for help reading trading charts, like a bit more clearly, you can check out VIP Algos. The link is right below in the description. So VIP Algos is this TradingView indicator suite, and it shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even, take profit and stop loss planning areas.
Right.
And you can use it across a bunch of market stocks, Forex, crypto, gold, indices, futures, you name it. But just remember, VIP Algos is strictly an educational chart analysis tool. It is not financial advice, it doesn't place any trades for you, and it absolutely does not guarantee profits. Trading inherently involves risk, so always manage your downside and do your own research. And just a heads up, this is an affiliate link, so we might earn a commission if you use it, but at no extra cost to you.
Awesome. So getting right into the heart of today's conversation, there's this massive, almost completely counterintuitive disconnect happening right now with SoFi. I was digging into the top line numbers, and this is a company sporting like over 200% trailing revenue growth.
Yeah, it's wide.
Right. To be exact, it's 205.53% year over year, which is just crazy. By all traditional logic, a fintech company scaling its top line at that speed, it should be the absolute darling of the market.
You think so, yeah.
But then you look at the chart, and it has just been this brutal battleground. The stock is down almost 29% year to date. It's trading around $18.62, which puts it at a staggering 43% discount from its 52-week highs. So you see 200% growth paired with a 43% drop, and you really have to wonder if the market has just, completely lost its mind here.
Well, the market rarely loses its mind completely, right? It's usually just pricing in some sort of risk that isn't immediately obvious when you just glance at the top line. But that tension is exactly why the setup is so compelling today. Because suddenly, the stock gap jumped over 5% in a single session.
Wow.
And it was accompanied by a massive surge in volume, too.
Which kind of forces the ultimate question for us today. Are we just looking at a dead cat bounce, like a temporary sigh of relief? Or is this the actual launch pad of a massive bottoming pattern fueled by their really aggressive lending footprint expansion? We basically have to unpack what the broader market is suddenly seeing right now that it was just completely ignoring a month ago.
Exactly. And to figure that out, we have to first establish what kind of animal SoFi actually is within a portfolio. Because misclassifying it, that's where I see a lot of investors getting burned.
Oh, for sure.
This is not your sleepy corner street commercial bank that pays out a reliable 4% dividend so you can sleep soundly at night. It's not that. It is a high beta fintech growth engine.
Let's hover on that beta metric for a second, because the data shows a beta of 2.22. And for anyone who might be, a bit rusty on their volatility metrics, the broader market just sits at a baseline beta of 1.
Right.
So when you carry a 2.22, you are strapping yourself into a roller coaster. It moves more than twice as violently as the S&P 500. If the broader market stumbles, SoFi doesn't just trip, it falls down a flight of stairs.
It really does. But conversely, when the market runs, this stock acts like it has a jetpack attached to it.
Exactly. So it requires a very specific iron stomach temperament to hold.
It absolutely does. And the reason they carry that extreme volatility, and frankly why they don't distribute profits as safe little dividends, is because every single spare cent they make is being aggressively reinvested into building out their ecosystem.
See, I always struggle a bit with the word ecosystem in fintech.
Oh,
because it feels like every single app with a sleek dark mode and a brightly colored debit card claims to have an ecosystem these days. A skeptic could easily look at SoFi and ask, isn't this just another crowded interface in a saturated app store? What actually anchors a user here long term?
that's a fair question. But the anchor here is actually the sheer misery of administrative life. Think about the last time you tried to change your primary checking account.
Oh, it's pure agony.
Right.
You have to update the direct deposit with your HR department, move the Netflix subscription, change the auto pay on the water bill, the electric bill, and you're just sitting there hoping nothing bounces in the transition. It's like a multi-week headache.
Exactly. And that headache, in business terms, is called high switching costs. And it is the entire foundation of SoFi's business model. They aren't just offering a checking account to hold your grocery money. They want to originate your student loan refinance, underwrite your mortgage, hold your emergency fund, and act as the brokerage for your retirement account.
They want everything.
They want everything. Once they seamlessly link all those disparate financial limbs into one single dashboard, a dashboard that talks to itself and optimizes your cash flow automatically, leaving becomes almost impossible. They are building a massive digital walled garden.
So the goal isn't just basic user acquisition, it's total financial entanglement.
Entanglement is the perfect word for it, and the numbers prove that the entanglement strategy is actually working. Going back to that 205.53% year-over-year revenue growth, that doesn't just happen by accident.
Right.
It shows they're successfully acquiring users, yes, but more importantly, they are successfully monetizing multiple verticals per single user.
But high growth in the tech sector usually comes with a valuation multiple that just makes you want to close your eyes.
Yeah.
We've all seen software or fintech platforms trading at 20, 30, or even 40 times their book value, which is just pure speculative frenzy.
Yeah, bubble territory.
Exactly. Yet the data here shows SoFi's market cap of roughly $23.88 billion is backed by a price-to-book ratio of just 2.21.
And that is the crucial distinguishing factor here.
Let's break that down for someone who maybe doesn't stare at balance sheets all day long. How should we visualize a price to book of 2.21 in this specific context?
Okay, so imagine a massive garage sale. A company is forced to sell every single desk, computer, patent, and loan they own, and then they use that cash to pay off every single debt they have. Whatever cash is left over in the lockbox at the end of the day, that is the book value. Now, if a company's stock price matches that leftover cash exactly, the price-to-book ratio is 1.
Meaning the market is valuing the company strictly for its scrap metal, basically.
Precisely. So at 2.21, you are paying a little over twice the scrap value. And, for a legacy, slow-growth bank, a 2.21 might be considered slightly rich. But for a hyper-growth tech disruptor scaling revenue at 200%, a 2.21 is remarkably grounded.
Wow, yeah.
It means you aren't paying some massive premium for a fantasy future. You are paying a very reasonable multiple for the actual equity sitting on the balance sheet today.
And they are actively trying to deepen that value, right? By building proprietary products to keep the money inside those walls. The recent launch of their SFYI ETF is just a fascinating move to me.
It really is smart.
It's essentially a bundle of their users' 50 most popular stocks, but it isn't just a basic passive index fund. They layer an actively managed covered call strategy on top of it.
Which is an absolutely brilliant retention tool.
It is. But covered calls can sound like total Wall Street voodoo to a lot of people. In plain English, how does that actually benefit the regular users sitting on their couch using the app?
Okay, think of owning a stock like owning a rental house. You hope the overall value of the house goes up over time, right? But while you wait for that to happen, you can also rent out the driveway for some immediate upfront cash.
Ooh, like that.
Yeah, a covered call is basically renting out the upside of your stock. You agree to cap how much profit you can make if the stock just skyrockets. And in exchange for capping your upside, someone pays you cash today. So SoFi is taking those 50 popular stocks and automatically renting out the driveways to generate steady yield for the users holding the ETF. It provides income, it reduces volatility, and most importantly, it keeps the user relying on SoFi for sophisticated wealth management, not just as a digital debit card.
Okay, so the walled garden is working, the revenue is exploding, the valuation is actually grounded. I have to play the skeptic now, though. Because the trailing net margin is sitting like a giant red flashed siren on this spreadsheet.
Oh, yeah.
It is at a deeply negative 19.79%.
Yeah.
That means for every single dollar they bring in, they are losing roughly 20 cents. You just cannot run a business on negative 20% margins indefinitely without eventually hitting a brick wall. So if they are scaling so incredibly fast, why are they bleeding so much cash?
Look, it is the single most valid critique of the company right now. And it is the exact reason the stock has been punished so severely over the past year. But to truly understand the margin, you have to understand the life cycle of heavy infrastructure. Let's step away from finance for a second and imagine a company building a colossal, state-of-the-art widget factory.
The upfront capital expenditure for that is going to be astronomical.
Astronomical. You have to buy the land, pour the concrete, import all the robotics, train the entire workforce. During that entire multi-year build phase, your margins are going to look horrific. You are bleeding billions.
Right.
But the day the factory is finally finished and you flip the switch, everything flips. The cost of producing the very first widget was $1 billion. The cost of producing the millionth widget is a fraction of a penny.
That's the magic of operating leverage.
Exactly. SoFi's massively negative margins are simply a result of them building their digital factory. Specifically, it's their aggressive expansion into a much broader lending footprint. They spent heavily on customer acquisition, the technological infrastructure, and securing the capital base to originate a vastly wider array of loans.
So the bet management is making is that the factory is finally built.
Yes. And as the lending volume pumps through that newly established infrastructure, the marginal cost of servicing each new loan will plummet, which should drag those negative margins right up into positive territory.
Which brings us perfectly to the catalysts. When does the market actually find out if the factory works?
The crucible is the upcoming earnings report. The exact date hasn't been set in stone yet, but this next print is everything. The street already knows they can generate 200% top-line growth. They honestly don't care about that anymore.
Right, that's priced in.
What the street desperately needs validated is the margin pivot. If management can show a credible, mathematically sound trajectory that proves this expanded lending footprint is finally creating operating leverage, the market will re-rate the stock violently to the upside.
But the brilliance, or maybe just the luck of SoFi's situation right now, is that they aren't just relying entirely on their internal operations to save them. The broader macroeconomic winds are suddenly shifting really aggressively in their favor. We are seeing declining treasury yields, falling oil prices, and a weaker U.S. dollar, all of which are easing the chokehold of inflation.
And why is the Treasury yield specifically the golden goose for SoFi here?
Because it basically dictates consumer psychology regarding debt. Over the last 2 years of relentless rate hikes, consumer debt has been like a clogged highway with incredibly expensive toll booths. Nobody wants to restructure their loans because the new rates are just punishing.
Yeah, you just stay put.
Exactly. You just sit in the slow lane and endure your 20% APR credit card or your high fixed rate personal loan. But when Treasury yields start dropping, it's like the toll booths lower their prices. Suddenly, the green light flashes.
It triggers a massive wave of refinancing.
Exactly. A consumer looks at their mountain of high-interest debt, realizes the macro environment just gave them a discount, and they basically sprint to refinance and consolidate. That is the exact environment SoFi's newly expanded lending footprint was built to capture. The dropping yields act as a massive tailwind for their core personal lending and refinancing volumes.
And while that massive macro wave crashes in, they also have that secondary catalyst we mentioned earlier quietly burning in the background, the asset gathering for the SFYI ETF.
Oh, right.
Every single dollar that flows into that fund increases their assets under management. And that generates a steady, recurring fee stream that requires almost zero additional effort on their part. It's a foundational stabilizer while the lending arm captures the explosive macro tailwind.
So the business model is primed, and the macro environment is finally cooperating. Do the technicals on the chart actually reflect that optimism, though? Because, fundamentals without supportive price action is just academic theory.
The chart is finally starting to validate the theory, actually. We mentioned the current price is $18.62. If you zoom out to a 13-week view, the stock is up 15.58%, steadily climbing out of a deep trench. The 52-week low was $14.92, which was set back in mid-May. And since then, we're seeing a very deliberate, methodical sequence of higher lows.
What really caught my eye isn't just the price itself, but the effort behind the price. The trading volume is currently sitting at 1.14 times the 3-month average.
And elevated participation is the key to trusting a move.
Right. When a stock just drifts up on low volume, it's so easily reversible. But when you combine a sustained 5-day gain, a 5% daily gap up, and above average volume, that tells you large institutional players are actively stepping in to accumulate shares. The footprints are in the sand. It strongly suggests a definitive bottoming pattern is locking into place here.
It really is a beautiful setup, but I think we need to inject a dose of technical realism here.
The overhead resistance.
The overhead resistance, yes. The short-term structure is undeniably robust, but we cannot forget that this stock is still down nearly 29% for the year. That means there is a tremendous amount of historical price memory sitting directly above the current price.
Zombie sellers.
That's a morbid but very accurate way to look at it. Think about the investor who bought into the hype at $25 or $30 a share. They have spent the last year deeply in the red, suffering through earnings misses and constant margin fears. The psychological exhaustion is real.
Oh, absolutely.
So the moment the stock rallies back to their break-even point, their first instinct isn't to hold for profit. It's to sell, get their money back, and just walk away. Every time SoFi pushes higher, it's going to run headfirst into waves of these break-even sellers. Chewing through that overhead supply requires immense sustained buying pressure. It will not be a frictionless rocket ride to the moon.
which makes understanding the current market sentiment absolutely vital. Are there actually enough eager buyers to absorb all those zombie sellers? Looking at the quantitative scoring, the broad sentiment is decidedly bullish. A significant portion of this is a halo effect from the broader financial sector. As yields drop, capital inherently rotates back into financials, which just kind of lifts all boats.
Furthermore, the PR around the SFYI ETF launch has done wonders. The market loves a company that doesn't just sit on its hands during a downturn, but actively innovates new products to diversify its revenue streams.
But when we talk about the velocity of capital in the financial sector, there's a macro data point worth observing, just to understand the sheer volume of liquidity moving around right now. Recent tracking data shows roughly $100 billion in capital commitments, flowing into various Trump-related accounts and entities across the broader financial landscape.
Just to interject, let's be very precise here. That capital is not flowing into SoFi's balance sheet.
Oh, absolutely not. It is entirely separate. I bring it up strictly as a neutral, macro-level indicator of sector activity. We're just looking at the data. When you have $100 billion of capital mobilizing and sloshing around in related financial verticals, it tells you that the market is highly active, heavily engaged, and highly liquid. That kind of dynamic, high-velocity environment generally provides a very favorable backdrop for a high-beta financial platform to operate in.
It definitely shows the consumer is not frozen in fear. They are actively deploying capital. But if we are looking for sentiment red flags, we have to talk about what the insiders at SoFi are actually doing with their own money.
Yes, this is the one data point that gives me real pause. Over the last 90 days, insider transactions show a net outflow of 236,909 shares. Breaking that down, it's 20 separate buy transactions against 26 sell transactions. When the executives running the company are dumping nearly 250,000 shares near the 52-week lows, it forces you to ask if they know something the retail investor doesn't.
Insider selling is a classic boogeyman in investing, and it always deserves scrutiny. But context is everything. You have to look at the pattern of the sales. What we are not seeing here is cluster selling.
Cluster selling being the panic button.
Exactly. If the CEO, the CFO, and 3 board members all unexpectedly dump 80% of their holdings on a Tuesday afternoon, the ship is sinking. Get out.
Right.
But the pattern of these 26 sells is highly dispersed and very orderly. Keep in mind, executives at high-growth tech firms receive a massive portion of their compensation in stock. When those options vest, they have to sell shares just to pay the massive tax bills. Furthermore, they buy houses, they send kids to college, they diversify their own personal portfolios. Given the massive operational expansion SoFi is currently executing, this slow, scattered selling looks much more like standard executive financial planning rather than a coordinated exit strategy.
Okay, that makes sense. But even without an insider panic, there are very real risks that could collapse this bullish thesis. I'll take the bear case here, and it brings us right back to the factory analogy. We are operating under the assumption that the factory works. But what if they build a bad factory? What if this grand expansion of the lending footprint fails to create actual operating leverage? If they scale up their marketing and infrastructure just to acquire lower quality loans that eventually default, that negative 19.79% net margin isn't going to pivot, it's going to widen.
And the market's reaction to that would be brutal. The leniency they are getting right now with that reasonable 2.21 price-to-book ratio is entirely based on trust and future efficiency. If they break that trust, the multiple compression will be severe. The floor could completely drop out.
There's also the macro trapdoor. This entire relief rally, the green light for refinancing, the sector momentum, it all assumes that inflation is dead and the Federal Reserve is going to continue cutting interest rates. But what if inflation proves sticky? What if the Fed stalls out and interest rates stay elevated for another 2 years?
That is the nightmare scenario for SoFi. The anticipated refinancing boom evaporates overnight. They would be left holding a massive, expensive lending infrastructure in a totally frozen credit market. And remember that beta of 2.22. If the macro environment shifts negatively, SoFi will be punished exponentially harder than a traditional bank.
So putting the massive growth, the negative margins, the falling yields, and the high beta risks all on the scale, where does the final verdict land?
The synthesis of all this research delivers a bullish score of 7 out of 10.
A 7 out of 10. How should an investor frame that in terms of a time horizon?
The data frames this as a highly compelling swing trade, specifically heading into the upcoming earnings report, so looking at a 1 to 3 month horizon. The ultimate elevator pitch is this. SoFi is offering a proven hypergrowth machine scaling at 200%, currently sitting at a 43% discount from its highs. When you combine that discounted entry point with the massive tailwinds of falling treasury yields and their successful expansion into wealth management, the risk-to-reward ratio is incredibly attractive for a tactical entry.
But we must add a heavy disclaimer here regarding portfolio fit.
Absolutely. If you are an investor nearing retirement or someone who relies on steady dividend income and low volatility to sleep at night, you need to be extremely careful with this stock. The extreme beta and the current negative margins guarantee this will be a bumpy ride. And of course, a reminder that this analysis is for informational purposes only and is not financial advice.
Before we wrap, I want to leave you with a final thought that goes beyond the current balance sheet. Think about the sheer volume of data SoFi is collecting through this walled garden. By acting as the checking account, the broker, the mortgage lender, and the student loan servicer, they possess a complete 360-degree real-time view of the American consumer's financial health. Traditional banks only see fragments of that. As we move deeper into the age of artificial intelligence, the ability to train predictive models on that kind of closed-loop, holistic financial data set is just unprecedented. Ultimately, their ability to monetize that data might prove to be a wider competitive moat than the banking services themselves. Just something to chew on as you watch the price action unfold.
Definitely something to watch.
Speaking of watching price action, if you want a cleaner, more efficient way to read trading charts, be sure to check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSO planning areas. It is designed to help you scan charts faster, but remember, it is an educational chart analysis tool only. It is not financial advice, it does not execute trades for you, and it never guarantees results. Trading inherently involves risk, so always do your own research and manage your downside. This is an affiliate link, meaning we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.